Hello and welcome. Today, we're diving into a pretty incredible story about cause and effect. We're going to see how one single data point, released on one ordinary morning, can send massive ripples through an entire country's economy, changing everything from its currency's value to the confidence of investors all around the world.
I mean, it sounds a little crazy, doesn't it? That one little number could hold so much power? But that is exactly what happened in South Africa. So today, we're going to follow the shockwaves from that single data release and see just how deeply it reshaped the country's whole financial landscape. All right, so our story begins right here with what you could call an inflation surprise. Think of it like a stone dropped into the perfectly still pond of market expectations. And that stone? It was the release of South Africa's January inflation data.
Now, before we go any further, just a quick refresher so we're all on the same page. The number we're talking about is the CPI, the Consumer Price Index. It's really the main tool for tracking inflation. Basically, it's just measuring how the prices of everyday stuff, things we all buy, are changing. A higher CPI means prices are going up faster. Simple as that.
And this is precisely where the surprise came in. You have to imagine, everyone was watching this number, holding their breath, and it came in lower than expected. This was a huge deal. It was a signal, a really positive one, that the trend of slowing inflation, what economists call the disinflation cycle, was still happening, even with all the uncertainty in the world.
And the key thing to get here is just how significant this was. Like the quote says, this wasn't just a tiny miss. This was the big, loud and clear confirmation signal that traders and investors had been waiting for. It told them, yes, inflation really is getting under control.
And with that signal out in the wild, the first ripple spread almost instantly. And its first stop was the country's currency, the rand.
This really shows the complete 180 in how the market was feeling. Before the data dropped, traders were playing defense, worried about global risks. But within minutes of that release, all that uncertainty just evaporated. The rand got stronger as all that anxiety was replaced with confidence that was now backed up by cold, hard data. It even made a risky strategy called the carry trade look attractive again. That's basically where investors borrow money somewhere cheap, like Japan, to invest at someone with higher returns, like South Africa, and pocket the difference.
But the ripple effect didn't just stop with the currency. The second, and much bigger, shockwave slammed into the bond market. Now, this is where the really big money moves, and the reaction here was just immediate and honestly profound. So over in the bond market, yields compressed, which is just a fancy way of saying they fell. What does that actually mean? Well, investors were suddenly so sure that inflation was handled that they no longer needed to demand a super high interest payment for loaning the government money. And this completely changed the entire outlook for what the central bank might do next. The market went from worrying about interest rates going up to betting that the next move would be a rate cut.
This quote just perfectly captures that very sophisticated change in thinking. For the big investors, the question was no longer if interest rates would eventually get cut, but when. They completely shifted their focus from guessing the direction of policy to making these really smart bets on the timing, how long the central bank would wait. It was a much more confident, nuanced game they were playing.
Okay, so we've seen the markets go wild. But why does any of this actually matter to an average person or the real economy? Well, this is where those ripples finally reach the shore.
The real-world impact is frankly huge. First off, lower, more predictable inflation makes it cheaper for the country to borrow money for really important stuff. We're talking roads, houses, infrastructure. Second, it gives regular consumers more confidence and more purchasing power, which helps the whole economy grow. And finally, it sends this powerful signal to global investors, the folks managing billions of dollars, that South Africa is a stable and reliable place to put their money.
And that right there brings us to the final and maybe the most important ripple of them all, earning global confidence. You see, this isn't just about having one good day in the markets, it's about building a rock-solid reputation.
Because, any country can stand up and declare its economy is strong and well-managed. But talk is cheap. True credibility, the kind that brings in long-term investment and creates real stability, that has to be proven.
And this is the powerful takeaway. Credibility isn't something you just get. It's earned, piece by piece, data point by data point. And on this particular day, with this one single number, South Africa earned a whole lot of it. It was like making a massive deposit into the bank of global trust.
And this really gets to the heart of how economic confidence is actually built. It's not through loud speeches or big promises. It happens quietly, decisively, and through the undeniable language of numbers. Each good data point builds on the last one, creating a stronger and stronger foundation of trust.
So that leaves us with a final thought to chew on. This one inflation report completely reset the narrative. But the story is far from over. That confidence has to be maintained, release after release. Which makes you wonder, doesn't it? What's the next number that's going to have everyone holding their breath?